Hey traders, welcome to our YouTube channel, where we delve deep into the fascinating world of trading and investing strategies. Today, we're unlocking the secrets of order blocks, those mysterious zones on the chart that hold the key to understanding market dynamics. Order blocks are more than just areas on a chart, they represent significant shifts in market sentiment and provide crucial clues for traders seeking to navigate the unpredictable waters of the financial markets. In this video, we'll explore what order blocks are, how to identify them, what is the confirmation criteria, and most importantly, how to leverage this knowledge to make informed trading decisions that could potentially transform your trading game. Don't forget to subscribe and hit the notification bell to stay updated with our latest videos. Join our community of aspiring traders. What are order blocks? Order blocks are pivotal areas on a price chart where significant buying or selling activity has occurred, typically driven by institutional traders or large market participants. These zones are characterized by pronounced imbalances in supply and demand, resulting in distinctive price structures. In essence, order blocks represent levels where substantial market orders were executed, leading to noteworthy price reactions. Why understanding order blocks is crucial for traders. That's because understanding order blocks allows traders to align their strategies with institutional trading activity, leveraging the footprints left behind by major market participants. By mastering the interpretation of order blocks, traders can navigate the complexities of the financial markets with greater precision and confidence, ultimately increasing their chances of success in trading endeavors. How can we identify an order block in a price chart? In an uptrend, an order block marks the last opposing candle before a significant increase in buying pressure. Similarly, in a downtrend, it's the last opposing candle before a significant increase in selling pressure. Think of order blocks as the footprints left behind by these major market players. When they execute large orders, it creates a visible footprint on the chart, indicating a moment of considerable market interest and activity. These significant increase in buying and selling activity are crucial because they're what actually create order blocks. Without them, there wouldn't be these distinctive zones on the chart. To put what we learned in practice, let's look at this price chart and try to identify our order blocks. Remember, by definition, an order block is the footprint left behind by major market players when they execute large orders. Typically seen as the last opposing candle before a significant price movement. So, to identify our order blocks, we have to locate areas with significant buying or selling activity. Now looking at this price chart, we can pinpoint 3 areas with significant increasing in buying activity. This is seen by consecutive candlesticks with long bodies and short wicks, moving aggressively to the upside. The last candles before these aggressive moves started will be our order blocks. So, we will mark them out and wait for the market to interact with them, presenting us with opportunities to go long. However, it is important to note that not all order blocks will be retested by the market. How do we distinguish between valid and invalid order blocks? Firstly, for an order block to be valid, there has to be a significant increase in buying or selling activity, that is seen by consecutive candlesticks with large bodies and small wicks moving impulsively to the upside or downside. If the price chart shows less buying or selling pressure, then that order block becomes invalid. This is seen by consecutive candlesticks with small bodies and big wicks moving correctively to the upside or downside. Secondly, our order block must not be retested by wicks or candles. Such order blocks are referred to as unmitigated and have greater potential of success. If an order block is retested by wicks or candles, it becomes invalid and traders should stay away from such. It is crucial for traders to distinguish between valid and invalid order blocks, as it directly impacts the accuracy of their trading decisions and the overall success of their strategies. Valid order blocks serve as reliable indicators of significant shifts in market sentiment, providing traders with valuable insights into potential price reversals or continuations. Now that we have a clear understanding of what order blocks are, their significance in the market, and how to identify them, one might think that trading using order blocks should be straightforward. However, there is still a slight problem. The market presents us with significant amount of valid order blocks daily. Trading all these order blocks without discernment exposes traders to considerable risks and increases the likelihood of capital loss. To mitigate this challenge and trade order blocks with a higher potential for success, professional traders commonly employ a set of confirmation criteria. These criteria serve as guidelines to filter out the most promising order blocks and reduce the risk of entering trades based solely on the presence of an order block. Firstly, our order block should be unmitigated. In essence, this means that once an order block is formed, it should not be subsequently retested or revisited by subsequent price action, such as wicks or candlesticks. In this price chart example, it is evident that this is the last candle before the significant increase in buying pressure, thus making it our order block. Upon close inspection, it becomes evident that our identified order block has not been retested by the wicks of the prevailing candlesticks. This characteristic renders it an unmitigated order block. Let's look at this second price chart example. Also, it is evident that this is the last candle before the significant increase in buying pressure, thus making it our order block. Upon close inspection, it becomes evident that our identified order block has not been retested by the wicks of the prevailing candlesticks. This characteristic renders it an unmitigated order block. Now looking at this third price chart example, it is evident that this is the last candle before this sudden gust of upward movement. So, this candle is our order block. However, upon close inspection it is evident that our identified order block was retested by a wick from this subsequent candle, rendering this order block mitigated and invalid. Going up a bit we can see that we have another opposing candle before this sudden gust of upward movement, making this candle our order block. Upon close inspection we can see that this candle was not retested by the wicks of the subsequent candles, rendering it unmitigated and valid. The second confirmation criteria is a fair value gap. Fair value gaps occur when the price moves away from its perceived fair value, creating a noticeable gap on the price chart. Let's look at this price chart example. With this candle serving as our order block, the gap between the wicks of our order block and the subsequent candle is referred to as the fair value gap, thus making it a valid order block. Examining this second price chart example, we identify the highlighted candle as our order block. It's notable that there exists a gap between the wicks of this order block and the subsequent candle, which validates it as an order block. In this third price chart example, the highlighted candle is identified as our potential order block. However, upon closer examination, it becomes apparent that there is no gap between the wicks of our order block and the subsequent candle. This lack of a gap between the wicks invalidates our order block. These gaps are crucial because they create an imbalance in the market which signals a discrepancy between the current market price and its perceived fair value. This imbalance can lead to shifts in market dynamics, potentially prompting a retracement to fill the gap. Market participants often view such retracements as opportunities to enter trades, anticipating price movements back toward equilibrium. The last confirmation criteria is a break of structure, which occurs when price takes out the previous high or low, and it indicates a significant change in market sentiment, often leading to increased momentum in the direction of the breakout. In this price chart example, this candle will be our identified order block. Following this pronounced upward movement, the market subsequently broke above the previous high, establishing a new high. This development confirms our setup. With this confirmation, we can patiently await the market to retrace and tap on our order block, presenting us with an opportunity to enter long positions. In this second price chart example, we've identified this candle as our potential order block. However, in this scenario, as the price surged upwards, it failed to surpass the previous high, thereby rendering this setup invalid. As long as price continues to trade below this significant high, our order block will remain invalid. However, should the market manage to push up and successfully breach this previous high, it would confirm our order block, thus rendering it valid. Therefore, it is crucial for traders to consistently monitor whether the market succeeds in breaking above a significant high before contemplating trade entries. This vigilance is paramount because the market's ability to breach previous highs serves as a pivotal confirmation factor for the validity of identified order blocks. By confirming such breaks, traders can ensure that their setups align with prevailing market dynamics and reduce the likelihood of entering trades prematurely or based on invalid signals. And there you have it, traders. These are the 3 most common confirmation criteria you will ever need before executing your trades. By adhering to them, traders can refine their trading strategies, increase the probability of successful trades, and ultimately enhance their overall performance in the market. Now, let's analyze this price chart and apply all we've learned so far. Firstly, we identify this candle as our order block. It's apparent that this order block was not retested by subsequent candle wicks, and there is a significant gap between the wicks of our order block and the subsequent candle. Following a sudden upward push, the market broke above the previous high, establishing a new high. With these confirmations in place, no retest, fair value gap, and a break of structure, our order block becomes valid. As a result, we can anticipate potential buy positions in the near future. Examining this second potential order block, it's evident that after its formation, there was no notable increase in buying activity. Additionally, it was subsequently retested by a wick of the following candle. Therefore, we cannot consider this candle as a valid order block. Amidst this upward surge, the candle positioned in the middle emerges as our potential order block. Notably, it was not retested by subsequent candle wicks, and there exists a significant gap between the wicks of our order block and the subsequent candle. Following the sudden increase in buying power, the market surged above the previous high, establishing a new high. With these confirmations in place, no retest, fair value gap, and a break of structure, our order block becomes valid. This will be our final potential order block. However, I'm interested in hearing your thoughts about this one. Do you consider this candle to be a valid or invalid order block? Leave your answers in the comment section below. Unfortunately, this marks the conclusion of our video. If you've made it this far, thank you for watching. If you found this video insightful and valuable, we kindly invite you to subscribe to our channel. Your support will help us grow and enable us to produce more insightful content like this in the near future. Thank you again for watching, and we look forward to sharing more valuable insights with you soon.